Welcome to REI Spotlight with your host, David Schwann. And today's guest is Rob Beardsley with Lone Star Capital Group. Welcome to the show, Rob.
Hey, thanks for having me.
Thank you for being on. Rob, give us a little bit of your background of how you got into real estate.
Yeah, so I got into real estate pretty early on. I come from a real estate family, so I grew up in the business. My dad likes to tell me that I was in diapers on construction sites, so it's kind of in my DNA.
Started you out young. Well, it's not a bad field to start out in.
That's right. That's right.
So born into the family. How'd you progress from there? What have you done?
Yeah, so my parents had done nothing in multifamily, and so I started researching multifamily and really just trying to look at real estate from a different perspective. They saw real estate as a job. They were selling residential real estate, building residential real estate, doing things that aren't necessarily creating generational wealth and really able to scale and grow a portfolio. And so that was the part of real estate that I found really intriguing. Aside from the deal structuring, the creativity involved in all that. So that's what really attracted me to it. And I was dragging my parents into it and saying, hey, this is something we need to open our eyes to. We need to see that this is a vehicle for long lasting or, wealth creation. And so that was, back in college, that was my first introduction to multifamily, and really gravitated towards that and saw that as really the most straightforward private equity business.
Definitely. That's it's amazing how many guests I talk to and how many people I've come across that, they've started on that single family. It's kind of the same thing. It's like they get started in a single family, and then, and same things, people that have done it for 10 and 15, 20 years, or, they've built a decent living off of it as their main business, kind of like your parents. And then it's like, well, I've never even really taken the time to view this sector of real estate, because I think a lot of them, they kind of, because they're in a single family side, and, at times there's so much of a grind. It's like, look, they were just sitting there, they're putting one foot in front of the other, just kind of doing what they do. And then they stop and they see multifamily, and it's like, guys like Joe Fairless and stuff like that, these guys are like, well, yeah, I had single family stuff. And every single one of them, it seems like once they get into the multifamily space, they just kind of start shifting out of it and going, I want to be in this multifamily space, which I think is why it's such a hot commodity right now.
Very true. And yeah, that single family transition to multifamily is people have discussed that over and over, and I'm definitely not an expert as far as the transition of the differences, but just to highlight those would be diversifying your risk, right? Rather than a single income source from one tenant in a single family home, you might have 200 apartments. So that's a much more diversified income source. And then you can also, with a larger asset, afford to have full-time staff on site, oversight from a regional manager, full professional management. And then also you have a lender who is your biggest investor in the deal, putting up the most capital, and they're a very sophisticated entity, and they are going to, order their required third-party reports, fully underwrite the deal, and really, stress test it. So you have to feel good if a lender is even backing on a deal just to get started.
Yeah. That's kind of they pay way more attention to a, $1, $2, $4, $5 million, $10 million deal. They scrutinize that and put a lot more effort into backing you up and making sure that your numbers are right and what your decision is than they do on a, $150,000 house. It's just economies of scale again, of like, look, even your lender has your best interest at heart. Even, on multifamily, it's a huge team, and it's like each team member has that drive for you of like, look, we want to make sure that this is stress tested and that you're going to do good. That, so you have those extra layers of that underwriting is pretty cool in multifamily space, I find.
Absolutely.
On stress testing, I've read a couple of your articles and stuff. What's some of the ways that you guys have gotten creative on stress testing and underwriting your deals to make sure that there's something that you want to get into?
Yeah, so I think the most interesting stress test would be an exit test, and this is performed by lenders, like we discussed. On uh, they look at when they're putting on a loan, whether it be a 3-year loan, a 5-year loan, a 10-year loan. They want to see that at the end of the loan's term, if they stress the asset's performance, market conditions, is there still enough value there and income to refinance the loan and still cover the existing loan? Because the worst situation for everyone is where you put on a loan with a certain amount of leverage, and when the loan comes due, you don't have enough equity built into the deal to take that existing loan out. And then people would call that it's a hung loan, or their bridge loan gets hung. That's most commonly. So this type of loan maturity risk is most commonly seen in bridge loans, which bridge loans sometimes get a bad rap. People say, "Oh, I won't invest in a deal with a bridge loan," which is definitely a fair way to tailor your investment preference if you like longer term steady cash flows and take less risk. But deals, just by the nature of them, that have the most upside and can produce the most outsized returns must be bought with a bridge loan, because permanent financing is not available for deals with less than 90% occupancy and things like that. So,
Well, yeah, definitely. And the bridge loan, it's like you said, I mean, if you're buying a property and you want a high return on your money, it's going to have risk, and those risks are going to take a product that Freddie and Fannie are not interested in something that's 70% occupied and needs a heavy lift. But if you're digging into a heavy lift project, you need financing. You have to get it somewhere. A bridge loan's what fits that, but that's how you start seeing a much more dramatic return on your investment, is by taking, it's a risk reward situation. And of course you're going to pay more for a bridge loan, and you're those things, but that's part of doing in that aspect of a heavy lift and a heavy value add. Is those bridge loans are a necessity to be able to take advantage of those situations.
exactly. And we take the perspective, we're not binary. We don't say, oh, well, we won't do any bridge loans, or we only do bridge loans. We look at it as, if we're going to do a project that necessitates a bridge loan, is there enough value to be created that actually substantiates the risk of the bridge loan? Because I'm seeing some groups, and this has been happening for a while as deals have gotten tighter and slimmer. They're buying deals that could be financed by Fannie and Freddie, but instead they're pursuing a bridge loan for that extra leverage, and to try to project a higher return via the leverage. And that is a scary situation. So for us, when we see a deal that is stabilized and fits in the agency box, we want to go agency. But if it has the upside, where, going back to the exit test on the stress testing, if we can show that there's enough upside where we raise the NOI, raise the value of the property, there's a big delta between the going in bridge loan amount. Let's say it's a $10 million bridge loan as we go into the deal, but we're going to create enough value that a stabilized loan from Fannie Freddie 2 years or 3 years later is going to be a $13 million loan. That's a $3 million difference between the going in loan and our projected takeout. So let's say we don't hit our numbers, or cap rates are wider at that time, there's still enough wiggle room that, okay, maybe we exit at an $11 million takeout loan. That's still a nice cushion. And then worst case scenario, I mean, obviously things can be worse, but worst case scenario would be you get a $10 million takeout loan, and that would be a cash neutral refinance. But at least you're able to get out of the bridge loan, put yourself in a stable situation, and then, take out loan maturity risk.
Yeah. And then that just kind of, you're making yourself prepared for a worst case scenario. It's like, yes, I'm aiming, in this situation, I'm aiming for 13, but if we miss it by 15%, we still have, it's like, look, if we miss it by 15, almost 20%, we still can hit our number where we have to be. It's like, so it's, and like you said, there's definitely people out there that when, when they're underwriting it, they're writing it so thin to be able to hit, to be able to put on paper certain numbers. And in reality, if anything, those projects, if a hiccup happens, they're not sitting in a good position. And, you know, that's, uh, that's why I like the way that you said that you're stress testing it, is because, that's, I, for my passive investing listeners out there, make sure that that when you're looking at a project that you're stress testing it, and that the sponsor has stress tested it, so that, you can ask those questions of, look, everybody should know now, we're kind of at the top of the market, where at least we perceive to be the top of the market. We don't know how much farther it's going to go, but it's all cyclical. So at some point it's going to come down a little bit, who knows how much, how far. Um, but, you have to build that in to be able to go, all right, well, if there is a risk, I have to make sure that it's built in and prepared. And some people want to go, well, you're just a doomsdayer. And it's like, well, no, I'm a realistic person, because it's going, at some point in time, it'll happen, whether it's big or whether it's small, it always happens. So it's just building in that extra stress test to make sure that you can get where you need to be.
Yeah, I like that a lot. And, like you said, we're at the top of the cycle. And for some people, it makes a lot of sense given their risk preference, that they understand prices are high, but they need to invest. We constantly need to be investing capital as investors. And, they'll accept a lower return by investing in a stabilized deal and paying a premium for it. But at least they're locked in to 10-year cash flows and have very little risk in a recession, in my opinion, if you're buying in a good area and you're not over leveraged, which Fannie and Freddie this cycle and pretty much all lenders have done a really good job of not over levering the real estate market. And that's really what takes down these big recessions, is lenders. The people say, if a recession happens, look and you'll see a lender. And so this, I think, has been a unique cycle in which lenders have really constrained to certain debt service coverage ratio requirements, leverage, LTV requirements. But even then, with 10-year debt, you should be able to ride it out. And then, on the bridge loan side, there's still those opportunities out there to find outsized value.
Definitely. And you had said part of it is a good property and a stable market. What are some of your criteria to pick a good market? How do you define a good market for you guys?
So a good market for us is pretty much how everybody else defines it. We're looking for a nice, stable, diversified job base. And typically what people say is no industry makes up more than 20% of the area's jobs. We like to see population growth. So something we're always looking at, and we get down to the census tract. So that could be just, even less than a 1 mile radius. And we're looking at that specific area and seeing what was the year 2000 census population, and then 2010, and then 2016. And obviously we're looking for an upward trend at minimum, but ideally you're seeing a 20% change from 2000 to 2016. That definitely gets us comfortable. And we really do see that as that's a nice way to quickly check. And usually if that checks out, most of the other boxes check out in terms of rents have been growing well, and properties have been appreciating, and other investors have been going and buying value add there.
Yeah, you usually, if people are moving in, there's usually a reason, and that's migration patterns can prove or show a lot. If there's an influx and people are wanting to be there, well, most likely if they're wanting to be there now, even in a downturn, people still want to be there. Maybe they may or may not be able to afford to get there, but it's still a desired location. And if you're in a desired location, that makes it easier even in tough times, because, face it, if you have a great location, if you have a product in a location that people want to live in, just because the economy's gone bad doesn't mean that people still don't want to move in there and live in your area and your property. So, even if it's, if you have that spot where people just want to be. Even in downtimes, people still want to be there. And so as long as you have that desirable location and a desirable product, even in a recessionary time, you should still factor out, should still do pretty well overall, because you still have something that's in demand, even if maybe not as many people can qualify to be in your property. You still have that demand and you still have that want, which that can overcome a lot.
Yeah, and that brings me to the next point, which would be looking at median household income. And first, the number is important. Just higher the better. But also looking at the distribution of incomes in the area. So, for example, if the median might be 40,000, but if you read in deeper into the numbers, and you might see that the distribution actually skews heavily towards 20,000 household income. So going that next layer and looking at the distribution of incomes is important. And then also, we're typically looking at deals where we can raise rents potentially 10 to 20%. We want to see that those pro forma rents that we're projecting to are still hitting the affordability box in based on the current household income in the area.
Yeah, not going, well, okay, this should be a great income, or, this should be a great area. We just need to attract people who make, $15,000 a year more than the current tenants. And it's like, no, you can't play that game. And I've seen some stuff that, some pro formas that have been wrote up that where the numbers, it's like, no, these people can't afford it. And I've even had a operator go, yeah, but once we're done, these tenants aren't going to be the tenants that are going to live there anyway. And it's like, you may be right, and that could be 100% accurate, but especially with where we're at in the market, do you really want to roll the dice on that being a definite, versus historical of, okay, we can get these rents, this income for this neighborhood can still support our new rents, so we should still be good.
Exactly. Yeah. And like you said, for a reposition play where you're really going to be re-tenanting the asset. So essentially, there's a current class of tenant, we'll call them, a class C tenant base. And you feel that the market has evolved there to now that there's enough class B type tenants, you might actually go in with a business plan to re-tenant the property with these different class of tenants that make that higher income. And then going back to the distribution, you want to see that there actually is a deep enough group of demand there at that higher income, right? So 40,000, maybe the median, but is there a nice 20% of the distribution making 65, 75, whatever that number is, if you're going to pursue that type of renovation scope?
Yeah, definitely. You want to make sure that that the neighborhood can support what your plans are, because let's face it, there are some neighborhoods around here where you can still get some really, really inexpensive properties, but they're D-class properties, and even if you went in and changed it to an A-class product, you're still not in an A-class neighborhood, and you're not going to attract A-class tenants, no matter what you put in there, unless you get lucky and you're just a savant. It's like, look, going it deep into the hood and putting in an A-class product, unless you know something that nobody else knows, that's not a good idea.
Right. Unless you have some inside information with Amazon or something.
Yeah.
But yeah, and I think the idea that it doesn't mean that you necessarily have to invest in class A areas only, or primary markets only, or really strong growth markets. There's plenty of great deals out there that exist in slow growth markets that have declining population, and B class areas and C class areas. You can buy deals everywhere. You just have to know what you're buying, and like you said earlier, project accordingly. If you're buying in a C class area, don't project that you're going to get B or A class rents. And we actually take somewhat of a contrarian view, because we do look at markets that maybe aren't as sought after by investors, and we still want to bid in those markets and still be competitive, but we adjust our underwriting accordingly. Rather than projecting rent growth, we'll come in and project 2, and that'll just be our own way to discount the fact that the market may not be as strong as another market, but at least we can, if I can still get, just put some numbers to it. If in a primary market that has good growth and I can safely project 3% rent growth, if I'm getting a 15% IRR based on those assumptions, that's a good deal. Or I could go to a smaller secondary tertiary market, rather than project 3%, project 2% rent growth and project a 17% IRR. That also to us is very interesting. We think that presents a risk adjusted return.
Definitely, definitely. And like you said, that risk adjusted return is like, look, um, unless you're in a area where, population's taking is on a nosedive and, everybody's just running out of town, it's like, yeah, might want to stay away from that. But like you said, if it's a slow growth area, if it's just steady, even if, like you said, maybe, even if it's slightly declining, but that it's those current levels, it may not grow much, but, the industries that are there aren't going anywhere. It's going to chug along. It's like, look, it's not going to grow much. It's not really, it's not going to skyrocket, but it's stable and it's been chugging along at this for a long time. And the industries and the people there, it's not going anywhere. It's not going to skyrocket, but it's not going to nosedive either. And it's like, look, if like you said, the adjusted returns make sense, why not be in a market like that? It doesn't have to be in those skyrocketing, not everything has to be in those skyrocketing hot markets. You can be in a little bit cooler market as long as the rest of the numbers and the rest of your basics meet what you need it to be. And that's still a good investment as long as you know up front and you understand what those demographics are.
Yeah, and like we talked about earlier about being at the top of the market, a lot of investors are concerned about the prospects of future growth. And in my opinion, I feel a lot safer buying a deal where I'm achieving a certain return predicated upon a lower growth assumption rather than being in the hottest market and winning the deal predicated upon 3-4% rent growth, knowing that we're potentially heading into a slowdown period where I was banking on 4 and I might actually have 0 for a year or two. That's going to greatly affect that growth strategy. But like you said, the slower, cooler market that's just chugging along, if you're only projecting 2% and you get 0, it's not going to hurt your numbers as much.
Yeah. And that's kind of, a lot of the stuff that I do. It's like, look, I stress test it to, especially right now, me personally, it's like, look, I've started, I do what I think the market's going to do, but at the end of the day, I still roll back around and go, well, okay, how far down can I go before this is busted? How, can I go 2 years with no rent growth whatsoever? Can I go a year with, maybe losing 1% of rent or 2% of rent just to stay competitive in the market? And those are not everybody wants to look at those numbers, and it's like, look, no, this is not what I'm shooting for, but I need to know that this is a possibility. And can I take these? If we take these body hits, can we survive a body hit like this? And it's just putting those numbers down and going, okay, yeah, we can survive this hit if it happens to take us there. And and that's just a kind of a key point that I've been kind of really looking at, is making sure that, like you said, it's like, look, just because it's been 4 or 5% for the last 3 or 4 years doesn't lock in that it's going to be at 4 and 5% the next 2, 3, 4, 5 years. It's we want it to be, but just because of what we want doesn't mean that's going to be reality.
Yeah, exactly right.
But yeah, just I guess the big point is just to make sure that we're stress testing our deals and make sure that we're understanding that the markets. And like you said, if you're in that tertiary market, you can't go in thinking with the data that is in a primary market, because that's not going to work out in your favor, because most of the time the tertiary markets are not growing at the same degree or same percentages as the primaries are. And
Exactly.
that's just part of the game of playing in a tertiary market.
Right, right. And so I think something that's been happening for the last while is as the primary markets have become more and more competitive and cap rates have gone down in those markets, investors are now starting to push out and reach for yield in the secondary and tertiary markets. And a lot of investors that typically aren't in those markets are now playing in those markets, and they're mistakenly underwriting those markets the same as they potentially would, like you said, in a primary. And in my opinion, like we mentioned earlier, you should roll back your assumptions, be more conservative in those tertiary markets, and on top of that, demand a higher return. So if you were previously getting if you comfortably get a 13 or a 15 in a primary, well, then you should be getting a 16, 17 in a tertiary. And then just recapping on the stress tests, we mentioned the exit test, being able to get out of your loan, which is a lot more realistic, and pretty much very easy to do on a 10-year loan, because 10 years out, everyone pretty much say America will be in a better place 10 years from now. There'll be more growth, more income. And also you'd have had time to pay down your debt via amortization. So that exit test is far more important for bridge loans. But then for the stabilized long-term loans, like you mentioned, stressing, bringing down the maybe negative rent growth, bringing down occupancy, and seeing, can I still break even on the loan? And that's the key, right? Being able to keep paying the debt even in hard times.
Yeah. And to me, it's like, look, I guess I'm a little bit of a realist, or just, it's like, look, I want to make sure that, my investors are covered, and that they, to me, it's like, look, we forecast a return on it, but my biggest thing is to make sure that your capital doesn't go anywhere. It's like, look, return of original capital is, of course, my first and foremost responsibility. Being able to profit and return after that, that's the goal, and that's what we're all shoot for. But to me, the ultimate golden goose part of it is don't lose the capital. I mean, that's the most important part of it for everybody, is don't lose the capital. That's why I think, having that stress test of, how far can we push it? How far, and looking at the historicals of, look, we've been through recessions before. What did this market do the last time there was a recession? What type of occupancy did we have? What type of, what type of rent growth, or, what happened to rents the last time around that there was a recession, because a lot of that stuff, it's like, no, it's not going to be identical, but you still have a feel for what the flavor is going to be if it happens. And then you kind of look at that historical stuff and kind of match it up to what you're doing now. And when you do that, then you kind of get a little bit, it kind of builds you up a little bit and goes, okay, well, at this number, we can go down to, if we go down to 70% occupancy, or, 70%, monetary occupancy, we can make that work. We can survive with that. Versus like, no, we have to be at 88%, occupancy, or we're not going to make it. If you're at that point, just, you can't go off of those assumptions that you're going to have that high occupancy, even if it's been at 95, 96% the whole time that you've owned it, or the previous owners owned it, whatever paperwork you have, you can't guarantee those. So you have to make sure that you're putting some hair on the dog to make sure that it can still float. We've definitely covered some stress testing and stuff. What's some of the ways that you like to give back to your community, Rob?
Give back to my community. What a good question. That's a tough one. I'm not necessarily in that stage of my life where I'm doing a lot of that, but I would say I love to teach. And so, when there is an opportunity to give back, and someone asks me a question or wants me to provide them resources, I'm usually really open with that. And I grew up teaching, whether I taught piano when I was younger, and I was a math tutor. And so I like to give back, and and do things
That's
like that.
yeah, that's an amazing thing. I mean, that's an amazing gift to give back to those who are wanting knowledge, and to be able to take the time and share your knowledge with somebody else. I think that is a highly noble cause to reach back. So don't take it so so nonchalantly of, no, well, I teach people. I think teaching somebody and educating somebody on something that you do, and especially in our field, where it's like, if you educate somebody and they take a hold of it, it could change their life. Even
Absolutely.
even little pieces of information, it's like, look, the information that you've shared on this podcast, somebody could take that information and run with that down the road, and that may change their life. So, just it's teaching, but it's not just teaching. It's you're helping educate somebody, and move them down the road, which I'm a very, very huge fan of. So, which is part of the reason why I do the podcast, is the educational part. So I definitely appreciate you, helping others out and helping people grow their business. What's a good way for my listeners, if they want to get a hold of you, Rob? What's a good way for them to get a hold of you?
So you can find out more about us at lonestarcapgroup.com, and you can email me directly at rob@lonestarcapgroup.com. I'm happy to share my underwriting model, which I built myself. People often ask me for that and find that to be a very helpful resource. And anything else, I'm happy to jump on a call.
Awesome, man. I'll definitely we'll put that in the show notes, and hopefully my listeners reach out to you, and they can you can help them, and hopefully they can help you. You guys move to your next level, and grow to that next level that you're trying to get to. Well, Rob, I appreciate you coming on the show and sharing your knowledge, and just thank you so much for being on. And until next time, thank you.
Thanks for having me.